Now, obviously, alpha is really easy to interpret, which is why it's a very popular measure of performance. But remember, it doesn't really tell you the full story in terms of total risk or idiosyncratic risk. It just tells you that you beat the factor benchmarks. But the other thing that alpha sort of has that's superior to these ratios is that, well, it's hard to really think of ratios as being interpretable. You know, what does a Sharpe ratio of, let's say, 1.5 mean? Is that good? Well, you can evaluate it relative to other Sharpe ratios using this ratio of ratios test that we did in the previous slide. But other than that, there's not really an objective benchmark the way that saying that you have an alpha of 2%, well, you know what that means exactly. You earn an excess 2% per year. But what we can actually do is we can create percentage-based versions of these risk-adjusted Sharpe ratio and Treynor ratio measures. And these are the M2 and T2 measures. So they'll let us transform these ratios that make sense relative to one to another but don't really make much sense objectively into percentage-based return measures that actually can be interpreted on their own. So how do we do this for the M2 measure? Well, what we're going to do is we're going to create a hypothetical portfolio, and we're just going to look at relative performance in terms of returns, or excess performance, I should say, of a hypothetical portfolio relative to our market benchmark. So here's how that is going to work. We're going to match the standard deviations in our candidate portfolio by either levering it up or levering it down, such that this new portfolio that we've created has the same standard deviation as that of the market. And once we've done that, we've essentially then been able to get rid of the denominator in the Sharpe ratios, right? Because if before what we had is the return on the portfolio minus the risk-free rate over the volatility of the portfolio, and we wondered whether the Sharpe ratio, how that was relative to the return on the market, minus the risk-free rate relative to the market standard deviation. Essentially what we're going to do is we're going to create a new portfolio that is invested partly either long or short in the risk-free asset. In other words, we're just moving up or down the capital market line, such that we, capital allocation line, I should say, such that we now have the same volatility as the market's portfolio. And then we can just get rid of the denominators and compare returns once we have set risk on sort of an even footing. So essentially what this is going to do is we're going to assign part of our portfolio weight to a risk-free asset, and this weight can be positive or negative. And since the risk-free asset, of course, has a standard deviation of 0, that means that we can create a new hypothetical portfolio that matches the market portfolio's risk in terms of total risk terms exactly. And once we do that, we can just compare returns without worrying for risk adjustment, because that has essentially happened implicitly. So what we're going to do is we're going to say that we're going to assign some weight to our candidate portfolio. We'll call that 1 minus W, and we're going to assign the rest, since those two weights will sum up to 1, we'll assign W to the risk-free rate, and we'll pick W such that the total risk of the hypothetical portfolio is equal to market risk. In other words, such that this equation holds. And again, you can view this as sort of if our initial portfolio was riskier than the market, we're going to invest some in the risk-free rate, thereby diluting the total risk of our portfolio such that it equals the market. And if our portfolio was initially less risky than the market, we're going to borrow at the risk-free rate and put more in that portfolio to bring its risk up. In both cases, the hypothetical portfolio will essentially be matched then in terms of its risk to the market portfolio. And we know what the expected return to the hypothetical portfolio then is as well. So first of all, what we can do is we can rewrite this equation that we have created sort of as a definitional matching of our sort of hypothetical portfolio that invests part in the risk-free rate, part in our candidate portfolio, such that its total risk is equal to that of the market. We can rewrite this expression to solve for the weight in the risk-free asset that makes it so, which is here. And then we can calculate the expected return to our hypothetical portfolio that now does have the same total risk as the market using this formula. Because remember, we've assigned now a certain weight to the risk-free asset, so we can then calculate the expected return on that portion as just the weight times the expected return on the risk-free asset, plus the portion that we've assigned to our candidate portfolio initially, times the expected return on that. Now that we've calculated the expected return on this hypothetical portfolio, and it has the same total risk as the market portfolio, well, then we can actually compare it to the market portfolio. Also, what we can do is we can substitute in our definition for the weight on the risk-free asset W from the formula on the prior slide, and this is the definition of the 1 minus W on the prior slide. And if we wanted to, we could actually collect terms in mu minus RF to get this sort of expression. And now what we're going to do is we're just going to say that our M2 measure is literally the difference between the expected returns on our hypothetical portfolio minus the market portfolio once we have actually risk adjusted the hypothetical portfolio already to be as risky as the market. So in other words, what this does is rather than comparing a per unit return relative to risk the way that the Sharpe ratio does, is first we either deflate or inflate the candidate portfolio such that it is just as risky as the market, and then we don't have to take ratios anymore. All we do is just compare expected returns on one versus the other. And the criterion for the M2 measure is the same as that of the Sharpe ratio. If the Sharpe ratio of our candidate portfolio is higher than that of the market, then once we adjust the candidate portfolio to be as risky as the market, the excess return, or the expected return on that portfolio should be higher than the market's as well, which would then mean that the M2 measure is going to be positive. And if it is, then that means the opposite, that the or that means, I guess, the same thing really, is that the portfolio is better than the market. So let's go through an example. Remember, our total risk was measured as follows. Our total risk of the candidate portfolio was 42%. And our total risk of the market portfolio was 30%. So what then is the weight that we would need to assign to the risk-free asset to make our candidate portfolio, that, remember, also has an expected return of 35%. What weight would we have to assign to the risk-free asset to make this candidate portfolio as risky as the market? Well, even before we do any math, we know that we will have to assign a positive amount to the risk-free asset, because right now this portfolio is more risky than the market. And what we have to do as part of this M2 calculation is to create a hypothetical that is just as risky. So we need to dilute our risk down using an allocation to the risk-free asset. How much should we allocate? Well, we'll just follow our formula for the weight derived on the prior slides, and we see that if we plug those numbers in, we need to allocate about 28.6% to the risk-free asset, and the remaining, I guess 71.4%, would go into our candidate portfolio. So we get the 71.4 by, again, just saying that that is 1 minus the weight in the risk-free asset. What then is the expected return to this hypothetical portfolio? Well, now we know how much we're assigning in terms of weights. We're going to just take 71.4% times our expected return in the portfolio, 35%, plus the 28.6% times the expected return to the risk-free asset. That's 26.7% in total, and that's the expected return to the hypothetical portfolio. We can also get the same result if we use that formula where we actually substitute in W and 1 minus W for the expected hypothetical portfolio return. Of course, that'll get us the same answer. But now, the critically important thing and sort of the valuable part of going through all this extra math is now we've calculated a expected return to a risk-adjusted portfolio already. It's got the same total risk as the market of 30%. We know that because we picked a weight in the risk-free asset to make it so. And now we can just literally take a difference of the returns in expectation of these two portfolios. Here's the expected return on our candidate portfolio once we have risk-adjusted it to be as risky as the market. Here is the expected return on the market. The difference, 26.7 minus 28, negative 1.3%, suggests that at least once we adjust for total risk, this candidate portfolio doesn't beat the market. Of course, that shouldn't surprise us because we already knew that the Sharpe ratio of the portfolio was less than that of the market. But really what the value add here is now we can actually quantify by how much in percentage terms this portfolio underperforms the market once we risk adjust. So the Sharpe ratios, having a lower Sharpe ratio in the candidate portfolio was informative. That told us this portfolio would underperform. The M2 measure tells us by how much once we risk adjust, by 1.3% per year. So the Sharpe ratio did tell us this idea that we were going to underperform, but again, this now tells us by how much. 1%, 1.3% less on a risk-adjusted annual basis, and we can put even dollar terms to this now if we want, because now that we have percentages, we can get dollars by simply multiplying by market caps. So let's say that we had 10,000 in a portfolio, and we were thinking of investing it in this candidate portfolio with the lower Sharpe ratio or the market with a higher Sharpe ratio. What would be the amount of money we would leave on the table by going with the candidate portfolio? The Sharpe ratios alone can't tell us this, but this M2 measure, risk adjusting and then comparing risk-adjusted returns, can. And we know that we would earn 1.3% less. 1.3% of our 10,000 AUM is $130. So that is how much we would leave on the table if we invested in this portfolio rather than going with the market while sort of taking the same amounts of risk. That's the crucial part in both cases. If all of this sounds complicated, the picture's worth 1,000 words, so here's a way that we can visualize it. Here's where we start. Remember, the portfolio we were given to evaluate had a total risk of 42%, expected return of 35%, and what we want to do is we want to say that this portfolio, by how much does it actually underperform the market? Well, while they have different risks, we can't really compare them directly apples to apples. Wouldn't make sense to say 37 minus 28. But what if we now do what the M2 measure suggests, is we de-lever this portfolio by sliding along that capital allocation line until we reach a point where the total risk of a lower leverage portfolio that holds this candidate portfolio as well as an allocation to the risk-free asset, because remember, that's sort of how you move along a capital allocation line, simply by taking either higher or lower positions in the risk-free asset relative to the risky asset. Once we delever our position enough such that our total risk is equal to that of the market, now here's our hypothetical portfolio with total risk equal to that of the market at 30%. The return that we had previously worked out is 26.7%, and then this gap between the expected return to the market and to the hypothetical portfolio at the same levels of total risk, which now is a gap that actually makes sense to consider, that is the M2 measure. And of course, as we saw, the market outperforms our hypothetical portfolio on a risk-adjusted basis. Therefore, it performs our given portfolio on a risk-adjusted basis by 1.3% per year. And in a way, the sort of information at the outset that the Sharpe ratio of the market is higher than that of the candidate portfolio was given in these capital allocation and capital market lines from the beginning in this graphic. Remember, the capital market line for the market portfolio was more sharply sloped up, in other words, had a higher Sharpe ratio than the capital allocation line for the candidate portfolio we were looking to evaluate, so it shouldn't surprise us that the M2 measure was indeed negative. Our candidate portfolio underperforms on a risk-adjusted basis, but the value here is now we know by exactly how much. Now, what about looking at the Treynor ratio? Again, the same idea. We can sort of tell Treynor ratios are better or worse relative to other Treynor ratios, but we don't necessarily know by how much in total objective amounts, either in percent or in dollars. So let's see if we can modify the Treynor ratio in a similar way to the Sharpe ratio to enable a risk-adjusted comparison in return terms. Really is going to follow a very similar recipe. The only key difference is that the T2 measure matches the systematic risk, whereas the M2 measure matched the total risk. But otherwise, it's going to be the same. We're going to create from our candidate portfolio a hypothetical that is now going to match systematic risk. In other words, if the beta of the market by definition is 1, we want to create a hypothetical portfolio with a beta of 1 by combining our candidate with a position in the risk-free asset. If we started with a beta above 1, we want to de-lever, take a position in the risk-free asset, reduce the beta of the hypothetical down to 1. And if we started with a beta below 1, we want to actually lever up and take a negative position, borrow at the risk-free rate, till we get to a beta of 1. So essentially what we want to say is, again, in the hypothetical portfolio, since betas are also linear in weights, as we know from our previous discussion of factor models, we can say that the beta of the hypothetical is going to be 1 minus whatever you've put in the risk-free asset times the beta of the candidate portfolio, because that's the amount you've put into the candidate portfolio, plus whatever you've put in the risk-free asset times 0, because the risk-free asset has 0 beta. And we want to pick W such that the beta is 1. And if we actually distribute in this beta p into 1 minus W, we can get an expression like this. Beta p minus W times beta p, that's equal to 1. And if we rearrange it to solve for W, just as we had previously rearranged our hypothetical portfolio solution to solve for W when we were setting total risk equal to that of the portfolio, now we can solve for W such that our systematic risk is equal to that of the portfolio. So here is the weight that then we are taking in the risk-free asset. Here is the weight then 1 minus that in the candidate portfolio. And so now we can again go and calculate expected returns. So what we could do is we can substitute in, remember the formula for expected returns is always going to look like this. The weight in the risk-free asset times the expected return on the risk-free asset, plus the weight on the candidate portfolio times the expected return on the candidate portfolio. Now let's just substitute in our expressions for W and for 1 minus W. And there we have a calculation for the hypothetical expected return. And then the t-square measure, similar to the m-square measure, is really just the difference then between the expected return on the hypothetical portfolio that has the same beta as the market relative to the expected return on the market. Now, the way that we will interpret this is, again, the same way as with the M2 measure, that a value greater than 0 will actually then be an indicator that this portfolio beats the market, but only in terms of systematic risk. And the important thing for both the M2 measure and the T2 measure is that you shouldn't really try to memorize their formulas. Really, if you just sort of focus on what they represent, the idea that all you're trying to do is just pick a weighted position such that either the total risk is the same as that of the market, or the beta is the same, systematic risk is the same as that of the market, then you can actually get these expressions for W and 1 minus W pretty much instantaneously. Whereas if you try to memorize them but don't remember what they actually mean, then you run the risk of memorizing them incorrectly and coming to the wrong conclusion. So it's much better to sort of remember what this process is about, which is risk matching, than what each individual formula sort of looks like committed to memory. Because once you understand the risk matching process, you can then recover the formulas. So how do we calculate the t-square measure? Well, first remember we have to actually calculate how much we want to assign to the risk-free asset. It shouldn't surprise us again that we want to assign a positive weight to the risk-free asset, because remember we start with a higher than market beta of 1.2. That means we need to de-lever to bring it down to a beta of 1. We know that this is the weight we're going to want to put in the risk-free asset because, again, the formula that really the one thing that we need to remember is what the beta of our portfolio is. And once we know that, let's call this beta of the hypothetical portfolio. Once we know that, we can recover all the other formulas we need. Remember, we want this to be 1, and we know that what it's going to be is 1 minus W times the beta of our candidate portfolio plus W times the beta of our risk-free asset, or 0. Once we know that, then we can actually derive this formula for the weight in the risk-free asset directly from this formula. So now we know that the weight in the risk-free asset is 16.7%. That means that the weight in the candidate portfolio is 83.3%. And that means that then the hypothetical portfolio will have a beta of 1, because we constructed those weights just so. What is then the expected return to the hypothetical portfolio? Well, it's going to be the weight on the candidate portfolio times its return, or 83.3% times 35, plus the weight on the risk-free asset times its expected return, 16.7 times 6%, for a total expected return of 30.16% on a portfolio that has a beta of 1. And now finally, what we can do is we can then create this percentage-based risk-adjusted comparison by saying that, well, on a risk-adjusted basis, our portfolio has, with the same systematic risk as the market, an expected return of 30.16%. The market has 28. We beat the market by 2.16% on a systematic risk-adjusted basis. Remember, not total risk in this case, systematic risk only, by 2.16% per year. This means that the T2 measure is positive. This portfolio is better than the market, at least on a systematic risk-adjusted basis. We earn 2.16% higher return than the market portfolio, while taking the same amount, and this is important, of systematic risk. Not total risk, just systematic risk. And of course, the M2 measure would give us the analog for total risk. And again, if we wanted dollar amounts, then for every $100 we invested in our portfolio, we would earn an extra $2.16. Relative to what we would have made by investing that $100 in the market. And if we want sort of a intuitive graphical version, we can view it again as, well, here's where we start. We have a given portfolio that has a beta of 1.2. And we know that that has an alpha relative to its expected return, which would fall in the security market line for a portfolio that has a beta of 1.2. That alpha is 2.6%. Remember, we calculated that back when we were actually computing Jensen's alpha. So this is just Jensen's alpha. This is the expected return to our portfolio if the single index model works. So now what we need to do is just take our given portfolio and either lever or de-lever it so that it has the same beta as the market portfolio. Remember, we aren't working with the expected return here. We're working with the actual return and beta of the given portfolio. So we're going to move down this line until we reach a point where the hypothetical portfolio has the same beta as the market of 1. That's, remember, where we assign about 16.7% to the risk-free asset. And then all we do is just compare expected returns to the hypothetical versus the market portfolio, 30.16 to 28. And that gives us, on a systematic risk-adjusted basis, an outperformance of 2.16%. So really what the t-square measure is just a rescaled version of alpha. We know that this portfolio has positive alpha. It therefore should have a positive t-square value. And all we're doing is just rescaling it by systematic risk. not by total risk. So the bottom line from all this analysis is that this candidate portfolio on a systematic risk basis outperforms the market, but not on a total risk basis. So there isn't necessarily a one-size-fits-all recommendation on risk-adjusted performance, and there often won't be. So that's why it's so important to know what each of these performance measures actually means, and when you want to listen to one, maybe total risk, or the other, maybe just systematic risk. Or perhaps, as with the information ratio, just idiosyncratic risk.